All right, some breaking news coming in at this moment. There's a virtual bloodbath on Dalal Street today. The Bombay Stock Exchange sensitive index has plunged by more than 900 points at opening today. The NSE Nifty is also down by more than 250 points. Rupee too has plunged by more than 50 paise against the dollar, touching a fresh two-year low. Let's go across to Editor Business Television, Vivek Law at this moment. Morning, Vivek. Why is this happening?
Well, Sanket, this has had, it's been in the works for a while now, isn't it? We've seen about almost 2 or 3 weeks of the Chinese markets really slumping far more than, what this 800-point carnage we are seeing here in the Indian markets. It's been falling almost every day in the last 3 or 4 weeks. It's down more than 30%. The contagion, so to speak, the emerging market contagion, so to speak, seems to be spreading. We saw some of the Gulf countries and their indices down very sharply yesterday, almost 7-odd%. And we've also seen the repercussions of that as far as the other global markets are concerned. So what we are seeing today is more an emerging market issue. So when the emerging markets are falling like the way they are, it's very unlikely that India is not going to be affected. In fact, so far, we've been less affected than some of the other markets, but it was only a time for us to catch up as well. So this is a global issue at play. Commodity prices have come down extremely sharply. They are at almost 6-year lows now. We've seen the Indian currency as well and other currencies as well. And of course, there are concerns about what the US Fed is going to do. Mind you, let's just cut back over the last few years. We saw a flood of money which was coming in from developed markets like the US into emerging markets. We had easy money coming in. We had excessive liquidity. That tap now seems to be closing down because the emerging markets haven't really performed. They're expensive and money seems to be going back. Now, have we seen enormous amount of money going out of India? No, we have not yet. And on the other hand, we've also seen a large amount of domestic money that has been coming in. So the Indian retail investors are coming in, and therefore we've seen some kind of a cushioning as far as the Indian market is concerned. But well, clearly the issue seems to be, in fact, some of the pundits are even saying that we are probably going to see a very prolonged kind of an emerging market bloodbath which is going to go on. They're calling it a global meltdown as well, but more specific to emerging markets. 2008 was a US problem. Now we seem to be going through what is an emerging market problem. Now, India as a country, the economy is, of course, growing. Could it have grown faster? Yes, of course, it could have. The recent logjam that we've seen in Parliament, the reform process not being able to go ahead, we had that MAT issue. All of this has not made us a standout to the extent that we could have been. But having said that, we've perhaps suffered far less than some of the other emerging market indices. Those, if you look at them, are way worse off than what we are. But these are challenging times. Investors are going to have to deal with this volatility. When you see a screen of the kind that we are seeing right now, 800, 900 odd points down, you do tend to panic. You do tend to press the sell button. But I think for a medium to long-term investor, you need to just stay put there and ride out this volatility. But this is not a one-off, one-day-off kind of an event. We are going to see excessive liquidity in the coming days and weeks.
That's exactly, Vivek, that was my follow-up question to you. On 2 counts, I want your opinion. Number 1, how long before things start getting better? And number 2, what exactly is in India's hands? What is in the government's hand to at least contain if this were to be called damage?
All right. The answer to your first question is it's very difficult, Sanket. I think nobody can really predict how long this will go. But one thing is very clear, that this seems to be now a deep-rooted emerging market problem. As I was mentioning earlier, you see, you weren't getting good returns in the US because the US was facing its own economic problems for the last few years. So you had a lot of money which was flowing into emerging markets. China is a big problem area. And we've seen the markets reflecting that there. As I said, over the last 1 month, the Chinese market is down over 30%. And now that's a big carnage out there, right? China has been the commodity engine. And the commodity prices are today down to 6-year lows. The good news for India is that we are still growing at 7% plus. And to answer your second question, well, we could have done a lot more. We've seen the recent set of reforms that have all got held up. We are seeing more and more experts coming out today and saying, well, you know what, you've done well as a government, but you haven't really done well enough. The reform process seems to be stalled. We are still growing at 7%, and even though if you see from our peaks of 30,000 odd points back in January, we are down only about 10 to 12%. But having said that, we are an economy which is chugging along. We are certainly far better off than some of the other emerging market countries with whom we were fighting for the money to come in. The one saving grace for us, Sanket, will be the fact that we have over the last 1 year seen a lot of money coming in from domestic investors, the mutual funds, the insurance companies. We've started seeing people like you and me coming back in and putting more money into equities. And that could be a cushioning. But having said that, we have received a whole lot of dollars coming in from FIIs and FPIs all over the world. And if even a small pullout of that happens, that's going to be a problem area as far as the market is concerned. The other good news on the macro is, of course, look at crude. When crude is today below $45 to a barrel, and we being such big importers of oil, that's good news for our macros. But clearly the government needs to do much more to be a standout country, because when the rest of the emerging market, let's just look at the psychology of the global investors, Sanket. They put out 100 rupees and they say, okay, look, we're going to go out of our country and invest in emerging markets, and then they divide it, within various countries. Today the problem is they are no longer confident about the entire emerging market piece, right? So the money is being pulled out. Now, unless you are a standout nation, where you say, okay, fine, I'm going to pull it out from the other countries, but I'm going to keep my money in India because it's so fantastic an opportunity. Are we really that? I'm not so sure at this point of time. That's not the way the FIs are looking at it. But this is not going to be a one-day event. Things are getting extremely hairy out there as far as the emerging markets are concerned.
Okay. Vivek Law, many thanks for explaining it in very simple terms, this entire phenomenon. We've got a market expert, Mr. S.P. Sharma, also joining us on the phone line. Morning, Mr. Sharma. What is your assessment of this huge plunge in the Indian stock markets?
I think it's majorly because of global market volatility, and there is no need to worry as India's economic resilience has strengthened during the recent times on account of factors such as improving FDI inflows and forex reserves, also reducing current account deficit and declining trade balance due to fall in international commodity prices. So I believe favorable inflationary scenario and several measures undertaken by the government to boost up investment sentiment will pay for the Indian resilience further. And I think there is no need for panic at this juncture, because though the volatility will remain for some time, but that may be capitalized an opportunity for the Indian investors to buy equity.